You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalog and listen to past episodes that you may have missed, like my conversation with Rich last week, where we discussed the March madness that we just experienced, as well as how the design of trend-following strategies allow it to be, quote-unquote, prepared for unforeseen events without overcomplicating the investment process. Also, if you missed the Wednesday episode, I would encourage you to listen to that one. It was a thought-provoking conversation with Barry Eichengreen, professor of economic and political science at University of California, about what we can learn from economic history in the current volatile global macro environment. And lastly, of course, I'm excited to invite you to enjoy the CTA mini-series where Alan and I have had the privilege of speaking with many of the decision makers of most of the largest CTAs in the world. And we dive deep into the most pressing topics and have gained unprecedented access to these industry leaders who share some exceptional insights really to the CTA world. So head over and check it out after you've done listening to Rob and me today. Rob, it is great to have you back this week. So much continues to happen in between our episodes. In fact, the last time we spoke, I just looked it up, was March 9th, which turned out to be an interesting weekend for the US banking system. But anyway, how are you doing, my friend?
Yeah, it's funny, isn't it? I made the cardinal mistake of boasting about my performance at that particular podcast. In fact, it was funny. I was speaking at a conference at a French bank last week, and I put up some slides that I prepared before March the 9th. And obviously, there was I had to say, well, you know, after the end of this graph, things change slightly, but the overall message is still the same. And yeah, there were some people at the conference from a certain Swiss bank that is no more, shall we say. And so, yeah, there was a few kind of awkward conversations going on in the corridors of that particular conference, I can tell you.
Absolutely. There was a certain Swiss bank that got rebranded, let's put it that way. All right, good to hear. We do have a great lineup of questions and topics, which, of course, I say every week, but I actually really mean it. So, but before we head over to that, let me do a quick market wrap. It's obviously been a shortened week, but investors did experience a little bit of a roller coaster ride this week. Interest rates continuing to trend lower in the face of mixed economic data. At the start of the week, the manufacturing and service surveys both came in weaker than expected, leading some to fear that the US was heading towards a recessionary environment. And this fear was compounded by weaker than expected readings in factory orders and durable goods. However, the back half of the week brought some good news as the US employment situation remained strong with March figures close to expectations. And while wages were a touch softer year on year, this was largely due to a payroll mix and reflects the fact that lower wage jobs are being added at the faster rate than higher wage jobs. Anyway, another bright spot in this week's data was the strong Q1 year-on-year sales again in the US auto sector, and that was up 8% thanks to increased supplies and steady prices. And while interest rates did rise slightly on Friday after the employment release, the rates market remains significantly lower than it was a month ago, as we just talked about here. The question in everybody's minds, of course, now is whether the crisis is truly behind us or if it is yet to manifest itself in the real economy. Really struggling with my words this morning, but anyway, Rob, I'm sure we'll get through it. Next week, by the way, we have some inflation data coming out, I think on the 12th, and we have some financial sector earnings coming out on the 13th. So no doubt another interesting week. But anyway, let's talk about what's been standing out for you, Rob, since you were last on the show. As mentioned, lots of things has happened since then, and especially in a place called Silicon Valley. I was wondering, you know, whether we should be concerned when you have a place like that consists of two words, namely silly and con, and then everything else happens from there. Anyways, that's a bad joke on a Easter Saturday. How are you doing? What has been standing out for you, Rob?
Yeah, it's been an interesting few weeks. Actually, another little anecdote. I was teaching last week And the lady who was lecturing before me came up to me and said, what is it you actually teach? I said, finance. I wanted to get into detail. She said, is Deutsche Bank safe? And I said, if Deutsche Bank goes, then we've got real problems. I said, as a depositor, your money's probably fine. I'm sure you'll be fine. But yes, obviously, it's really very much been a year of, 3/3, I suppose, is the most accurate way of putting it. So the first third was the period up till when, I was talking to you guys, March the 9th, March the 10th was okay, I think. And then obviously a horrendous few days happened. And actually, ignoring that, the next couple of weeks have been okay. Actually, I'm actually up slightly since my low. But yeah, so I personally lost actually around 7.5% on that particular weekend, which I think is slightly better than average. Looking at kind of across the industry at other funds, but anyway. And where does that leave me for the year? Well, for the year, that leaves me down, unfortunately, about 2.5%. About 2.9% actually, so nearly 3%. Biggest losses, no surprise to hear. There's a lot of bonds in that particular bucket. So US 20 years, German 10-year bonds, US 5 years, all making an appearance there. So obviously these are all positions where I was short bonds and got trashed when the market rallied on the back of that banking news in the US. Not all bad though. Some positive performance. Interestingly, quite a good performance in lean hogs. And also in US gas, and made a little bit of money in VIX as well. So, but on net, mainly losses, unfortunately. And yeah, bonds and equities, metals, and FX actually all losing money as well. Just looking at the sector split. So my positioning now actually, so I've been saying for quite a while now that my risk is quite low, and it's even lower now. So having scale back positions even further on the back of a shock, as you'd expect Tron following to do. So my analysed risk now is running at around maybe a quarter, a fifth of my long-term target. And my biggest risk now actually is in the ags markets. So the bond market slipped to second place. So I've trimmed my position in bonds quite considerably, although I do still have a modest short in US 2-year. But I'm long. In fact, I've got very few positions, and actually I could list them all quite quickly.
Just
but I'm
the
not going
themes
to.
are fine, exactly.
Yeah, but it does illustrate, the kind of situation where we've really gone from, we've really cut back our positions, as you'd expect, given that things have moved against us. So not really a huge surprise, kind of probably in line with most people in terms of my experience of the year and the few 4 months we've had so far.
Yeah, I mean, it sounds like it for sure. And of course, we know now that the SG indices, the CTA index, the trend index had their biggest 2-day loss on the 10th and the 13th, 14th, whenever it was. So it was on an unusual period of time. I think it sounds like you did pretty well. Of course, as I briefly talked to Rich about last weekend, I think this period in particular will certainly have a lot of dispersion in returns, mostly driven by just the markets and the exposure levels that people would have had towards fixed income, and that's fine. I mean, that's how it should be. This week, after an exciting quote-unquote March month, it has been a very quiet week performance-wise as far as I can tell, even though it got off to a little bit of a bang when the OPEC people decided to cut the production further by, I think, 1.1 million barrels per day. And that was a bit of surprise. So we have seen some decent moves in the markets this week. But when I was kind of briefly looking at the funds that I follow intra-month, looks like performance so far in April is pretty flat, also from the indices. And from what I can gather, there were maybe a little bit of a challenge in some of the Japanese equity markets for trend followers, but on the other hand, commodities did pretty well. So anyway, it seems to have offset each other pretty well. So when I look at the numbers as of Thursday night, because of course we don't have the numbers for Friday, which would have been very small change anyways because of Easter, beta 50 is down 4 basis points for the year, down less than 4% for the month, and down 4% for the year. SocGen CTA index down 14 bips for the month, down 5.34 for the year, and the trend index is flat, down 7.3% so far this year. So nothing too much. Short-term traders are down 18 basis points in April. They're down 2.29 in March. For the year. And equities doing well, up 7.2 for the world equity markets, MSCI World. For the year, the bonds are up 0.5% this month, and the S&P 500 index is almost up 7% for the year. Now we'll run through a few questions. I don't think they're that long, and then we'll dive into the topics that we have talked about, Rob, in advance. The first one is a message for you. It says, "Dear Rob or Robert." It's from Ricardo, and he's just asking, when are we, he says, going to write a book on Python backtester to trade equities, futures, foreign exchange? ?
So Ricardo is a good friend of mine who actually lives in the same town as I do. So he's deliberately winding me up now, basically.
But you have just finished one book, so I guess it's time to think
I know.
of the next
He's
one.
like, you need to start on another book. The answer is truthfully, Ricardo, probably never. I'm a bit. I don't like the idea of writing books with code in them, like about Python and stuff like that. One reason being, you have to. There was a few reasons actually. One is that programming languages and things are dynamic; they change over time, and that means you need to keep reissuing the book and rewriting the code in them, or they get out of date. Now that's great if you're a publisher that does that sort of book, like Wiley, for example. They've got a lot of these books, but it does mean a lot of work for somebody, and that would be me. Another reason is that they're quite complicated books to write. The books are pretty complicated anyway, but you've got to write all the code, you've got to test it, and so on and so forth. And and then you get lots of people kind of contacting you, asking for clarifications and saying, "Oh, this won't run, this won't run." And again, that happens with other books anyway. People will write to you and say, "Well, in this formula here, what do you mean by this? What do you mean by that?" But with code, it's literally something like, "Well, I typed this in and it didn't work. What are you going to do about it?" I just don't feel that that's the kind of thing I want to do. Our good friend Andreas Klanau, who we talked about his reissuing of his classic book on managed futures recently. I think his third book was actually a book of this kind about backtesting equities in Python. I know he's had some problems with the fact that it was about a particular library that's no longer supported, and he gets lots of questions coming in, and so on and so forth. So Ricardo, he's gonna. I think the next thing he's going to do is like hire a plane to fly with a banner going past my house every hour with saying, when are you going to write this book? He's very, very keen for me to write it, because he personally would like to read it, but sadly, I think the answer is no.
He should write it, of course. Then.
Well, yes,
exactly. I thought of another reason why you wouldn't want to do that was it would be an interesting challenge to do the audio version of it.
Quite.
All right, well, let's jump to a question from Bruno. Bruno writes, "Let me express my gratitude and admiration for your podcast and you and your roster of impressive guests." So that would be you, Rob, and everyone else, of course. "I would like to ask Rob a question on dynamic position sizing and the need for volatility forecast. One thing that isn't addressed in great detail, in my opinion, is the apparent contradiction of using historical volatility as a predictor of future market conditions when defining position size. This is a bit like the critique many people move to VAR, value at risk, which is like driving while looking in the rearview mirror. Does Rob advocate using a model of any kind to produce a volatility forecast and let this risk budget fluctuate according to market conditions, or does he see more value in having more empirical approach and using a blend of historical volatility, perhaps using different look-back periods? What would be the main reason for his choice of one paradigm and the other? And what would be the most important features of Rob's volatility model should he develop one?" Okay, good question.
Yeah, it is a good question. Yeah. So this is kind of one of those unspoken assumptions that we use historic vol, but actually what we really want, of course, is future volatility, but we don't have access to that. Now, the good news is that the single best predictor of future volatility is actually historic volatility. To be more precise, if I measure the volatility using standard deviation over a number of different lookbacks, in other words, so if I look at, vol over the last few days, vol over the last few weeks, vol over the last 6 months or the last year, and then I use that to predict what volatility will be in the near future. And again, I can look at a number of different holding periods for my asset. What I will find is that the single best predictor of future volatility, regardless of your horizon, actually, is the volatility with a look back of around a month. And that's true with whether I use a simple standard deviation that just takes and equally weights all the returns from the last 20, 25 business days, or whether I do something more sophisticated and use an exponential weighting, which is what I use myself. And if you do a regression, and you which is a measure of how well Y predicts X, if you like, you get an R squared of about 0.4, which actually is extremely good. If I try and do a regression like that and try and predict correlations, I'll get an R squared of about 0.2. And if I try and predict means or Sharpe ratios, I get a very, very weak R squared indeed, because it's much harder to predict those. Now, you can improve that volatility model in a number of different ways. So one obvious thing you can do is to use implied volatility. So the implied volatility of an options price is effectively it's actually mainly driven by the market's forecast of what volatility is going to be in the period up till when the option expires. But there is a caveat there, which is that options are systematically overpriced, and we can earn this thing called a variance premium by selling gamma, as they say in the options world, and delta hedging it. We'll expect to earn a kind of a positive return over time, occasionally losing money if the market moves a lot. So it's a classic kind of negative skew trading strategy, selling gamma. But putting that to one side, we can use implied options, implied vol from options data. I don't do that personally, although when I was at AHL we did do that, and I assume that they still do that, because there's a fair bit of work, because you've got to bring in the volatility and do some calculations and then back out the effect of the variance premium. There are other things you can do in terms of getting more and more sophisticated, so that the academic literature is littered with various volatility models. So you've got things like GARCH, for example, which, let me see if I can get this right. One of the reasons, because people are wondering why both Niels and I are stumbling a bit this morning, is we're actually recording quite a bit earlier than we normally do because of Niels' travel schedule. So I think we're both a bit tired. But GARCH, I think science stands for Generalized Autoregressive Conditional Heteroskedasticity.
The good news, Rob, is I wouldn't know, so I can't even correct you here.
Yes, but I know for sure there's at least a couple of people listening who'll know whether I got that right or not, but I hope they did. But these are basically ways of kind of weighting and modeling the volatility in various different ways. So I do something like that, but and which the Bruno actually kind of talks about as well, and that's that I use a mixture of a blend of a very slow estimate of volatility and this 1 month one I've already talked about. And the reason I do that is because volatility is a process that is predictable in the short term in a sort of stationary way. In other words, if vol's been high recently, it'll stay high. If it's been low recently, it'll stay low. But it also mean reverts as well at longer time frames. So if equity market vol is currently very high, so above, say, 40% annualized standard deviation, it's unlikely to stay that high for more than a few months. So to account for that, I include a very slow estimate of volatility that kind of pulls in my quick moving estimate. And one implication of that is, which is very important for someone who's in a sort of CTA business, because we size our positions inversely according to volatility. So if volatility is very low, we'll increase our positions dramatically and have more leverage. So if volatility is very low, we'll have a lot of leverage on, and we'll be very exposed to potential market shocks. And by combining a short and a long-term estimate of volatility, that means that I won't be putting quite as much leverage on in those low vol periods, and I'll be less exposed to the market shocks that are happening. One more thing you can do just before I finish, you could throw in there is you can include intraday data. So even though I'm running my system mainly at a daily frequency, one good estimate of improving vol is to bring in, just for your vol estimate, some the last couple of days of, say, hourly data, and that allows you to pick up early on a kind of something happening in the market that the daily returns aren't yet showing up yet in a big way. So yeah, a simple 1 month look back of vol does a really, really good job and will get you 90% of the way there. And there are all these refinements you can throw in that will do a slightly better job of improving your estimate of volatility. And that R squared number would maybe go from 0.4 to 0.5. That's not necessarily going to improve your returns, but it will make your distribution a little bit more stable. And if you've got the time and you want to put the effort in, it might be worth doing. It's a kind of marginal gain, I would say.
Sure. Great stuff. Thanks very much for that, Rob. All right, here's the last question, or set of questions, is from Skip. Skip writes, "Hello, Niels. I would like to ask Rob a few questions. The first question, and pardon the pun here, I'm going to skip because we already talked about it. It's about performance, so we already done that. But the other one will be, I know that Rob is not a pure trend follower. How is the overall performance of the portfolio affected? Is there any comparison when using only trend versus his other trading rules, carry, mean reversion, based on backtest, for example?" So I'm not sure, you may understand this better question than what I do, and where Skip is going with this.
Yeah, I'm just trying to see if I've got an up-to-date report that will answer Skip's question. I'm not sure I do, sadly. Just bear with me.
Other than just general terms, obviously.
Yeah, no, actually, I do have an up-to-date report. So I think what Skip's asking is, over the last few months, clearly trend following would have suffered in March, but did other trading rules that I run, that like for example carry most famously, would they also have suffered, or would they have provided diversification? So I'm just quickly scrolling through a very, very long report, which actually has the performance for all my different trading rules in it. I'm not yet seeing any good news, it's fair to say, but just bear with me.
It's not that long then.
Yeah, exactly. Yeah. Well, it includes performance going back for various periods. So there's a year-to-date report, but also kind of longer timeframes as well, and it breaks it down by every single type of trading rule I have, and there's a few, to say the least. So that's why. I mean, so I'll just talk while that report's loading. The reason for including lots of different trading rules, just to sort of take it back to basics, is of course, we would hope that would provide us with diversification in the same way that adding more instruments to our portfolio also provides us with some diversification effect. It's unfortunately I now have the sort of spinning wheel on the computer that indicates that the computer is like, no, this report's too big. I'm not going to load anymore. So, but what I can say to you, Skip, is a couple of things from a kind of theoretical perspective. If I look at bonds and look at carry, I probably would have expected carry to potentially have been in a similar situation to trend, because the yield curve was actually pretty flat, I think, going into the crisis that happened. And actually that's one of the reasons for banks being in trouble, because banks like steep yield curves, right? They want to be able to essentially borrow money at the front of the yield curve from depositors for low interest rates, and then put it into long maturity bonds and mortgages and other investments like that, with higher interest rates, and make money. And the situation that they've been in recently means they've had trouble doing that. And people have been listening for a while will remember from Cam Harvey, who we interviewed for the macro series, that a flatter inverted yield curve actually is potentially a sign of bad economic times to come as well. So there's something there. So in theory, it's quite likely that carry in bonds would also have been short, and wouldn't have, specifically in bonds, been much help in that particular episode. But the other thing I will say, Skip, is I'm going to, in the next few weeks, do some analysis of my performance the last 12 months, which I do every year. It sort of aligns with the UK tax year, which goes up to April. And that analysis will include a kind of full analysis of all the different trading rules that I run. So you can check in on my blog, and maybe next time I'm on, I'll talk about that topic again.
Okay, cool. And then final question before we dive into your topics, or our topics, I should say. If you had to pick one trading rule, trend, or something else, what's kind of your...
I hate this question.
You have to choose between your children here.
Exactly. I was going to say exactly the same thing. It's the choose between your children question. But because, carry has, in the backtest, carry has a better Sharpe ratio, but not as good skew as trend following, and vice versa. I'd probably pick trend following. I don't see how I could.
I mean, there was only one real correct answer, I should say, on this. So I'm glad you picked the right one. Okay, cool. All right. Thanks for the questions, and thanks for your kind comments, Skip. And let's jump into some topics. Now, the first topic, when you raised it to me, Rob, I thought, is this really interesting? I mean, just being completely transparent here. But then you just gave me like 30 seconds, and I thought, yeah, this is probably relevant for us to spend a couple of minutes talking about. So can you reveal what this mystery topic is?
Well, I can. So, Niels, do you know what April the 14th is this year? It's a special day.
April the 14th this year.
No, it's not my birthday either, in case you're wondering. You haven't got me a present.
I mean, if it's related to this topic, I kind of guess, but could be the last trading day of something.
It is, yeah. So April the 14th is the day that if you own a Eurodollar future, which obviously is a US interest rate future, based on the Libor rate, it will convert into a different kind of future. It will convert into an SOFR future, which is a secured overnight financing rate future. I think this is an interesting topic for a number of different reasons, actually. So the first is, as a futures trader, it's quite unusual for this to happen, right? So it's quite unusual for the market to say, okay, that future that you own, we're going to take that away and replace it with a different future. Futures do delist from time to time. Futures often become moribund and no one trades them anymore. And the CME or whoever decides it's just not worth the hassle of keeping them on the books, so they delist them. It does happen. A recent example would be the big S&P contract, which delisted, I think about a year and a half ago. And now we've just got the micro and the mini, because everyone just switched to trading the micro or the mini. They're like, well, we don't need the big contract anymore. And another example actually would be in lumber. So they changed the definition of the lumber contract, and the old lumber contract stopped trading, and there's now a new lumber contract which is defined in a different way. But it's really unusual for a big high volume contract like the Eurodollar future, which is one of the largest volume contracts in the world, to be replaced like this. And of course, it all ties back to Libor itself. Libor. This, I'm speaking from kind of quite close personal experience here with this. But Libor was a measure of interest rates based on a survey of banks that was done every morning. So literally in the olden days, someone had rung up all these banks and said, where can you borrow or lend for 3 months today? That survey clearly is open to potential manipulation, and indeed several people have gone to jail and been prosecuted with that manipulation, including some people I know quite well because I used to work with them. So I was sitting at the start of my career in investment bank trading. I was sitting a few meters away from people who, unbeknownst to me, were fixing Libor and have subsequently served jail time for it. This is not the place for a discussion about whether that was really illegal, or whether the law was effectively changed and applied retrospectively. I've blogged about that if people want to know. But yeah, I think it's quite to me, this is one of these once in a lifetime things. I don't think that this is going to happen again. So it feels like quite a compelling thing. So yeah, if you happen to own any Eurodollar futures, then something weird and magical is going to happen to them. And at a more kind of pragmatic level, if you're like me and your system's fully automated, a lot of things are probably going to break. So just be aware of that. One thing, for example, that will happen is the price will actually jump by, I think it's 26 basis points off the top of my head. But basically, because these things are not quite the same thing. So one is a secured rate, one is an unsecured rate. the S in SOFR stands for secured. So there's going to be a difference in price, and there's a difference in the credit, and SOFR is actually based on real market trades rather than on a survey, which is of course the reason why they're replacing Libor. The whole Libor saga has been a very long and turgid one, and I think the issues of Libor potentially being fixed were first raised somewhere in sort of late 2007, if my memory is correct. So it's been 16 years to get to this point. But yeah, it feels like an important day that's worth marking. And yes, it's a bit nerdy and it's a bit kind of fixed income nerdy, but to me personally, it means quite a lot. So I would have felt bad if I hadn't mentioned it.
No, I'm glad you did. Absolutely. It was not on my radar per se, except that I've seen obviously that we also stopped trading euro dollar a while back. But anyways, now you wrote a blog post about another topic, which may on the surface seem also a little bit nerdy, but you said you assured me that it's not. So let's run with that. And it's about the wonderful topic of estimating standard deviation.
Which we've touched on already. So yes.
Right, exactly. So
yeah, so actually this is a bit less. This is actually about a kind of either or question. So, and actually this is something that happens a lot, because often you'll see in the headlines of the news, they'll say, the S&P dropped by 100 points today, and actually that's one of the things I really hate seeing in newspaper headlines, because unless you have in your head a mental model of what 100 points means, it's completely meaningless, right? So what people really ought to do is convert that into a percentage and say, the S&P dropped by 2.5% today, which you think, that's a kind of that's not a massive loss, is it? It's kind of a bad day, but it's not a terrible day. But obviously in the newspaper, the S&P dropped 100 whole points today. Mentally you're thinking, wow, that sounds like a lot. But really, it's really not. And they never do that with something that has a small, small dollar on it. So they would never say, the price of this went up by, just this. They would report the percentage to make it seem bigger. I guess that's what being a journalist is all about, sadly, grabbing headlines. So I personally prefer often when looking and thinking about, price changes to do them in percentages, right? Because it's, it's same when I'm reporting my P&L to you guys every week, and I said, I'm down, just under 3% for the year. I didn't say, I'm down,
50 million.
50 million. I wish deals. Yes, I wish. I don't think so. A lot less than that. But it wouldn't mean anything if I reported to you a dollar amount. It wouldn't mean anything, right? So so it's kind of in terms of thinking about price changes, I think percentages are important. And in terms of like reporting standard deviations, so saying, my long-term standard deviation target is 25% a year, and that would translate on the S&P to 1,000 points or something, But actually, in terms of calculating standard deviation, there are actually good reasons why you should not use the percentages. So when you're actually sitting down and saying, right, I'm going to get, say, the last 25, 30 days of returns, and I'm going to put that into a calculation to estimate what my risk should be, which is what we were talking about earlier, you shouldn't use percentage standard deviations. And there's a few reasons why not. Okay, so the first is that prices can actually sometimes go negative. We've seen that in the last, almost exactly 3 years ago. The price of front crude oil went negative. And clearly it's nonsensical to divide something by a negative number, because unless you do something about it, you're going to end up with a negative number for your standard deviation, which doesn't make any sense. The issue isn't so much the going negative; it's when things get really close to zero. So if you imagine something like crude oil, which 3 years ago was probably moving about an average of $5 or $10 a day. $10 divided by $50 is 20%. But $10 divided by $1 is 1,000%. So what you'll see happen is if you're using percentage standard deviations, if a price starts to go towards zero, then the percentage returns will get bigger and bigger and bigger, even though in reality the market volatility is still the same. the price is still, there's nothing. It's not like the market regime's changed. We just end up with these ridiculously huge return numbers. You might say, well, Rob, how often do prices really go negative? I mean, you can only think of one example, the last 3 years. But because of the way that most people build their futures backtesting systems, we do this thing called generating a back-adjusted price, which means essentially we join together the prices of lots of different contracts that have traded through history. If you do that with a contract that has a positive carry, like, for example, bonds, as we've discussed, normally you earn a positive carry on bonds. What you'll find is that the adjusted price as you go back into history gets lower and lower and lower, and at some point quite possibly will turn negative. So if I pull up the price of US 10-year bonds in my system, it's going to go from maybe about 100 now to, and about 30 years ago it'll be zero. And before that it'll be negative. So that this issue with calculating percentages on very, very small numbers will be another issue. So what will happen is my standard deviation estimates, even if nothing's really happened to the market, will get bigger and bigger and bigger as that price approaches zero, and then they'll get smaller and smaller again. So they'll just be really strange numbers. And there is a way of getting around that, which is to use the actual price of the contract as it was trading then, rather than the back adjusted price as the denominator in your calculation. But which I prefer to do. But again, that won't get you away from the issue of things going to zero. And the final reason for doing this, which may not be that obvious, is actually it is the price change that you care about in terms of actually scaling your positions. Because if you think about kind of a basic idea of how you're scaling your positions, let's say you want to take $1 million of risk in something. Well, you want to know what the dollar risk is of trading that thing. And that's going to be equal to the standard deviation measured in price terms multiplied by the value of each contract. So for euro dollars, as we've been discussing, that would be $2,500 a point. For 10-year futures, it would be $1,000 a point, and so on. So yeah, it is a bit of a nerdy and a geeky conversation, but it's an example of something that's kind of going on under the hood of a lot of systems that people may not properly appreciate. And it's an example of when, if market conditions change and your system's not sufficiently robust. So, for example, if you were using percentage standard deviations, and a price suddenly went negative, and your whole system would just go, well, whoa, hang on a second. The best thing that would happen is that it would just, throw an exception and crash. The worst thing that would happen is that it will just carry on but produce really weird results, which you wouldn't necessarily pick up on straight away. So, this business isn't that complicated, but it really helps sometimes to have a real focus on attention to detail on some of the small things going on. So again, it may seem a bit nerdy, it may seem a bit uninteresting, but I think it's something that people should be aware of.
Well, we're going to shift gear now, and we're going to pull some punches, because there was an article called Trend Following, Rolling with the Punches, from our friends over at Man-AHL that, again, on the topic of trend following naturally, but also in relationship to what we've just been through and crisis periods. I know you had a quick chance to look it through. What were your main takeaways, Rob, from the article?
Yeah, I mean, it's an interesting article. So, I think the important caveat is that these pieces are written, by the kind of sales side of the business, really. They're not kind of necessarily super serious pieces of research. And I think we should always have in mind that Man, although they're a great firm, and as I often say when people, they paid for my house, so I kind of have a sort of a legacy of appreciation towards them. But they're high quality pieces. But we should always bear in mind that the motivation is to, like houses to a degree, is to say, well, trend following is good. And when we have these periods like March, we know, basically don't panic. That's the message and that's the motivation, and that should always be borne in mind. But having said that, as I said, it's a pretty high quality piece. So, they say, well, what actually happened? Well, as we've discussed, SVB, Silicon Valley Bank happened, and then UBS, Credit Suisse, and another US bank as well. US 2-year Treasury yields specifically moved by the most they've moved since Black Monday, October '87. But it wasn't just that. There's quite a few markets that saw reversals in their prices. So the US Treasuries were the most dramatic, but quite a few equity markets also showed sharp reversals. Some FX markets showed sharp reversals. Even Nat Gas actually showed a sharp reversal. So it wasn't just that single market that caused those sharp losses. It was because a lot of things switched direction on the same day. Because obviously as trend followers we normally try and be diversified, and we wouldn't have had that big an exposure to just one US fixed income market necessarily. But then they said, well, okay, that's kind of the bad news, but can we kind of look at history and have an opinion about generally how trend following behaves around these kind of crisis periods when we see sharp reversals? And they've taken a bunch of historic periods when these reversals happen. So for example, July 2007 was one, November 2001 was another. And they've looked at the performance in three periods. So before the reversal itself, and then after the reversal. And so the first thing to say is, well, March was bad, but actually interesting, March 2007 was worse because, the stock market had been going up, and then the kind of news about the initial credit crisis news started to filter in, and things reversed quite sharply. So that kind of puts it in a historical context. But the other thing that they do is say, well, you know what, if we take an average of all these periods in which trend following saw a sharp reversal, how does trend following do after that? And the good news is that on average, it actually pretty much makes up the reversal, and if anything, within 12 months actually has a small profit. So, it does seem that after a sharp reversal, there is a kind of technical term, negative autocorrelation returns, or less technically, a bounce back in improvement. Now, of course, we should say that this hasn't always happened. So, for example, in February 2018, or in the 12 months following February 2018, it basically went sideways for 12 months. It didn't recover any of its previous performance. So that's an average. It's quite an interesting piece, and with the usual caveats that it's a bit of a sales piece. It has a motivation to encourage people to look into trend following, but generally speaking, I'm of the view that they always say, when's the best time to buy stocks? And the answer's, well, if you believe stocks are going to go up in the long run, the answer's today. Trying to time your trying to get out of stocks after they've done badly, or getting into them when they've done well, unless you're running some kind of systematic trend following model on stocks, there is a bad idea. Similarly, when if you're going to have an investment in a risk premium type strategy like trend following, I believe you should try and stay exposed to that as much as you can, and not panic and get out when things have gone badly. I'm not sure that there's enough evidence in this article to say that the best time to get into trend following is now, because the market's suffered a reversal, and after reversal, things are always going to come back. I'm not sure, that they kind of spin that tail. But I think the message is, if you are invested in trend following, that there's no reason why you should be particularly concerned about further poor performance from here. But yeah, it is what it is.
That's what it is. And of course, there's absolutely nothing wrong with being a little bit biased toward trend following on this particular podcast, I would say. And it reminds me of a quote that our founder, Bill Dunn, would say, and that is the best time to invest in trend following is at the bottom of a drawdown. The second best is today. All righty. Well, of course, we talk about trend following in terms of during a crisis period, but that kind of nicely leads into another topic, which was an article that was published in, I think, in Bloomberg this week. And of course, ideally, a lot of people really want to have protection of their portfolio, ideally protection that doesn't cost them anything. And we can certainly think of one strategy that does that over time. But of course, when we talk about tail hedge and we talk about protection, there's one particular individual that often is associated with some strong opinions, both his own and of others. And that is, of course, Nassim Nicholas Taleb, who is the author of a number of important books, I guess. And also, he's an advisor to a firm, I guess you would call them a hedge fund, called Universa. And Universa made some headlines back in 2020 because of the way they quoted their returns during COVID. Thousands of percent they quoted that they had made. And I think there was a lot of discussion on social media about the way that they approached this. And now there is, again, that this article came up. And I kind of forget the details of the article. I have to say, there's just so many things going on right now. But I did read it. And I did listen to a podcast, actually, with Nassim Taleb this week. He did come across much more mellow, I have to say. Not very... maybe it was just because the two hosts were more in agreement with him, I guess, than in disagreement. But it is an interesting topic, of course. I know you only had a few minutes to kind of glaze over the article, but this thing about tail hedge, this thing about how to quote your returns without them being kind of eye-catching and controversial, kind of goes a little bit to this thing you talked about before with small denominators can lead to very high.
Yeah, I mean,
numbers.
This is quite nerdy as well, right? This is
well, let's try and make it not too nerdy, because I think there's another controversial topic coming up after this one.
Yeah. So I think actually I'm going to listen to that podcast you mentioned, because I don't never listen to rival podcasts, Niels, unless you give me permission to. But I think one thing about Nassim Taleb, and indeed like a lot of people, I mostly see him on Twitter, where of course he comes across as this very kind of, aggressive personality. And in real life, I've never met him, but I have met people who have met him, if that makes sense. So I've got a kind of second degree connection to Nassim Taleb. They say he's, much nicer in real life than Twitter. And that's true probably of nearly everyone, including me, I would say. So I hopefully come across, even on this podcast, as much nicer than on Twitter, because in Twitter, of course, sometimes you haven't got time to be nice. You just have to say what you got to say, and I think that's an accepted part of the medium. So tail hedging is a fascinating topic, and there are better people than me to talk about the mechanics of tail hedging and how you do it. But the basic idea is this: that you're essentially buying insurance against a market downturn without it costing you a net amount of money. So and we talked about this already, if you systematically buy options and delta hedge them, you will systematically lose money because of this thing called the volatility premium. Essentially, the market makes you pay for insurance. Okay, and that cost gets worse if you buy massively out of the money options because of this thing called SMILE. So basically, post October 87, the market has said there's a possibility of this massive outside move happening, and therefore we're going to charge you a lot more money for, say, 20 delta out of the money put options, which would be the sort of thing you'd use to insure against a market catastrophe. And the other thing is that the bid-ask spreads on those out of the money options tend to be quite wide as well. So that combined with the volatility SMILE means it's a very expensive way of protecting yourself. But it is the only sure way of protecting yourself. So, trend following empirically has protected you against certain kinds of market crashes, but not always, right? So it wasn't much help in March. It wasn't much help in March 2020 either. But it was a big help last year, over the course of the year when the classic 60-40 portfolio got absolutely smashed and trend following did very well. But it's not a guarantee of protection. So it's not really a true crisis alpha insurance product, shall we say. The only true crisis alpha insurance product is, well, either keeping all your money in cash, which in which case inflation will stuff you, or yes, buying these out of the money options that are very expensive. Then what tail hedging funds try and do is to do that sort of insurance buying in a more selective way, and without going into details, because apart from anything else, I'm not an expert. What they're trying to do is buy insurance when it's relatively cheap, and buy certain kinds of insurance that's cheaper than others, and potentially pay for their insurance by selling other options that are rich and all these kinds of tricks. And that means they will never be a perfect hedge, but it means if they do their job well, they can still be a hedge against crashes without costing you a net amount of money in the long run, and potentially even making you money in the long run. So let's switch away from the specifics and just think of an analogy which most people may be more comfortable with. So let's say you want to insure your house, okay? So let's say your house is worth, I don't know, €500,000. And the insurance company says to you, okay, we're going to insure your house for, I don't know, €500 a year, which is 0.1% or 10 basis points of the value of the house. And on average, the insurance company is kind of making profits and stuff. On average, when you'd expect over the lifetime of that house insurance that they would make money. So you might be paying €500 a year over, say, 20 years of ownership, which adds up to €10,000, I think. And you make maybe one claim for something happens to the house. You make one claim for €5,000. So you're a net loser of €5,000 on that. That's basically what will happen if you're a naive tail hedger who just buys out of the money options. That's essentially what's happening. You're going to lose money in the long run on that deal. Now let's suppose that you manage to find a tail hedging manager, or in this analogy, an insurance company that's not very good. So it'd be an insurance company that's not very good, or maybe you're a really smart person who really knows how to buy a really cheap insurance policy, so you're the equivalent of a smart tail hedger. So you're paying your €500 a year in premium, but instead of getting 5,000 back in claims, you actually get 12,000 back in claims. Okay, so you make a €2,000 profit over the life of your policy. Over 20 years, that's €100 a year of gain, effectively. Now, Niels, the question is this. This is the question the article arises. That €2,000 in profit, and this comes back to what we were talking about earlier, what is that as a percentage?
Yeah, that's the question.
Yeah. So you're going to try and answer, or?
I'll leave you to do all the answering.
It's too early.
Today,
it's too early for both of us. I'm lining up these cues, and Niels is trying to keep his eyes open. Okay, so there's two ways of thinking about this, right? So one way to say, well, my house is worth €500,000. That €2,000 of profit I should divide that 2,000 divided by 500,000, which is obviously going to give me 0.25%, I think, something like that. It's going to give me a small number, right? A small percentage number. But another way of thinking about this is to say, well, actually, your 10,000 euros of premium, you should divide by that. So you've made 2,000 euros profit on 10,000 euros of premium. So you've actually made 20% profit. Or you could even say, well, on the money you've paid in this year, the 500 euros you've paid in this year, you've made, 12,000 back. So you could say it's 12,000 divided by 500, which obviously is going to be, a big 4-figure percentage return, which looks amazing. Now, it's not going to be too difficult to guess, given the choice, which of these three options you would quote, right? You're obviously going to quote, you're not going to say, we make our clients, 0.25% a year. Because they'll go, oh, okay, that's not really particularly impressive. But if you say, we make our clients, 11,000% a year or some other big number, then they're going to be like, wow, that's incredible. And that's obviously going to be in the news, it's going to be on Bloomberg, and people are going to be very impressed by it. The question is whether that's really a valid number or not. And it's a very difficult one, because these tail protect funds, although we call them hedge funds, they're very different from a normal hedge fund. Because, with a normal hedge fund, you hand over your investment and you say, right, and the gains and losses come, and it's quite easy to say what the percentage gains and losses are. With these tail protect funds, what you do is you hand over your premium, you hand over your insurance premium, and they do what they do. And then if you make an outsized gain, then obviously and you hand over your premium, but you also say you have a bigger amount of money, which is the amount you're insuring, right? And that's the 500,000 euros of value of your house. And they don't have kind of control of the full 500,000. So they say, well, we're not going to use that as our denominator in our percentage calculation. We're going to use the premium. And that's where these big numbers come from. So, in a way, what they're doing is kind of correct in one sense of the word, because there's, except maybe in an accounting sense of the word, when there's perhaps one right way of doing this, and if you know a good accountant,
which seems important.
Yeah, well, yeah, but we all know, a good accountant will say to you, well, what would you like the number to be? So But in terms of tax and stuff like that, I guess there's an important number to come in there. But actually, in terms of kind of economic value, I think these guys should be, that quoting these big numbers is unnecessary. Any tail protect fund that makes money in the long run should be proud of themselves because, it's not an easy thing to do. They're fighting against this variance premium. They're providing insurance against market crashes. I think they should be more honest and say, well, we cost you money in insurance, but in the long run you'll get it back and some more. And it's not a lot more, but it pays you off. And the important thing is that kind of the important thing to say here is that we shouldn't really be judging these funds on the returns anyway. We should be judging them on the package of returns they produce when combined with a portfolio, with a long-only portfolio, right? Because that's the reason you're buying them. You're not buying a tail protect fund as your only investment. Because that's a pretty rubbish investment, right? Where you pay out money year after year after year, and every now and then this huge money comes back into your account. Most people, don't want that sort of return profile. You're buying it as insurance to hold with another asset. So what they really should be doing is saying, well, and this is kind of what the CTA industry tends to do as well, because in isolation, a CTA performance might not look that great, but combined with 60-40, with the diversification power you get, all of a sudden it looks really good. And that's the marketing these guys should be doing as well. They should be saying, well, this is your equity line. Okay, now what happens if we add tail protect? This is your equity line. And the drawdowns are much reduced and the overall return is unchanged. But brilliant. That's fantastic. They don't need to do this headline grabbing stuff of quoting return in thousands of %. I think it's unnecessary, frankly.
Thank you for that. Now, we had two more topics that we had discussed. Luckily, we only have room for one in terms of time. Even more stroke of luck, we don't have much time, but the topic, speaking about headline-grabbing content, is something you came up with called reasons not to trend follow. And I can hardly say the words, so it's very hard for me to express that sentiment. But Rob, as always, I'm sure there is a very good reason why you would even consider bringing this up as a topic. So, and I have no idea where we're going to go with this. Let's spend a few minutes on this as our final topic for today, because of course, I'm sure there's a good reason for it.
Well, the one reason is just to make the podcast more interesting, Niels, because week after week, you kind of.
So you're doing a universa. You're coming up with headline grabbing stuff.
Well, yeah,
too.
exactly,
Okay.
exactly.
I like your thinking. Sure.
Yeah, well, week after week, people tune in and listen to people agreeing with each other. So let's. Okay. I feel like we should put the other side of the story in.
I think we should.
Yeah, absolutely. Okay, so reasons not to trend follow. Okay. Here we go. Controversial.
Yeah.
Controversial. So I guess the main reason you wouldn't necessarily do trend following is that you just don't believe in it. Okay, you don't believe that. I think one thing that trend following lacks personally is a single compelling narrative as to why it works. We've got lots of theories. I've got my own personal favourite theories around things like behavioural biases and prospect theory, and you can Google all this stuff if you're interested, and loss aversion and so on and so forth. Other people have theories around the when information comes in, that people are slow to react and underreact to information, and that produces trends. But yeah, at the end of the day, and this is true of a lot of kind of so-called risk premium type strategies. So the same is true for things like equity value. Same is true of carry. There's not a reason why this should work. And in the absence of a obvious single compelling reason as to why something should work, you're kind of left with empirical evidence. As we've discussed right at the start, that's backward looking. Something appearing to work in the past doesn't necessarily mean it's going to work in the future for a number of different reasons. It could be that your backtest is overfitted, for example. It could be that you've forgotten to take something into account, and this isn't so important for trading costs, but things like trading costs, for example, or survivorship bias and all these problems you get with backtests. But the most obvious reason why something could have worked in the past and not the future is that things change. So, if it is a behavioural-based narrative, you could argue that as more and more investors use systematic methods, or indeed are replaced by computers entirely, or maybe people will just learn not to have these biases anymore. That's the first potential reason. So Niels, I think the way we should do this section is I'm going to say these reasons, and I think you should be the defender of trend following and tell me why I'm wrong on each of these points.
I think I might have a slightly different, a little surprise for you coming up, Rob. So
okay,
let's continue a little while longer.
All right. Okay. I'll bring up my next point then, shall I? Okay.
Yeah.
Is the surprise, Niels, that you're secretly not a trend follower, and this whole time you've been like a Soviet sleeper agent waiting to?
I think I can reveal that's not the case.
Okay,
but,
that's fine.
Yeah.
Okay. The second reason why you wouldn't necessarily invest in trend following is on a standalone basis. Actually, it's not that compelling an investment, and we kind of briefly talked about that. So, it's not the kind of Sharpe ratio 1.5, 2 that you can get in certain other types of strategy. And one of the reasons for that is those other strategies have other unpleasant attributes in terms of risks. So, for example, they're solidly negative skew strategy. So option selling, for example, can be a very good strategy looked at in terms of Sharpe ratio, but it has really ugly Sharpe drawdowns because of that negative skew profile. So with trend following, you're kind of, to an extent, paying off some of your return to get some positive skew, and it's just a question of how much you value that positive skew. And you could also you can also say, well, it does well when combined with 60/40 because it provides diversification. But again, this is a kind of weak empirical result rather than a mathematical certainty like tail hedging. Okay, so it's not guaranteed that you'll make money in a market crisis with trend following, whereas that is guaranteed with a tail hedge strategy. Although, as I said, a pure tail hedge strategy will cost you money. So a lot of it depends on your preferences around Sharpe, around skew, around tail protection. So trend following kind of sits in the middle on these things. So if you really want tail protection, trend following is probably not for you. You should buy a tail protection fund, or just buy out the money puts. If you really want, positive skew, then again there are other assets. There are other types of investments, like, for example, buying out the money puts. Again, is a very positive skewed strategy. If you really want good, solid, high Sharpe ratio returns, then you're better off probably with a negative skewed strategy that has a high Sharpe ratio but really ugly Sharpe drawdowns. Trend following kind of sits in the middle of these. So it comes down to preferences, really. The other thing about trend following is, on an individual asset basis, it really is rubbish. Okay, it's got very low Sharpes on an individual asset basis. And it's only when you diversify across a number of different instruments that you really get the benefit, and the Sharpe sort of shoots up to the level where it becomes a sort of attractive investment in its own right. And so, if you want to do your own trend following, and if you haven't got a massive account, and we talked about this before, then trend following is probably not for you as an individual investor. So that means you're stuck with things like, for example, doing it but with just single equities and maybe not being able to short, so you'll still get some of the benefits, but you're losing a lot of it because you haven't got the diversification across asset classes. You can't short, you can't benefit from markets going down, or alternatively you can invest in a fund, and there are UCITS funds, so there are kind of retail friendly funds that do this stuff for small account sizes, but they've got fees, which means you'll be net a loser compared to if you could do it yourself, of course. Okay, I've got. Are there
any more left?
One more. I could go on all day, Niels. There are so many.
I'm sure you. I hope you can't. But anyway, let's do one more.
I've only got one more left.
Okay, fair enough.
Okay. Trend following is hard. Okay, it's a very difficult strategy to stick to, the discipline that's required, unless you run it on an automated way like I do, because you've got to sit there and take all those small losses and then when the big win comes, kind of hold on to the position and not close it early and take that kind of early profit. So it's a very emotionally hard strategy to run, and this of course is again why I think it'll work, because this is inconsistent with my first point, because the harder it is, the fewer people are going to be able to do it. And it is interesting, actually, that the kind of size of the CTA industry, which isn't exactly the same as trend following, but as a percentage of kind of total hedge fund assets, has remained at about the same level for probably 25 years. I think that's a really interesting result. It does indicate there's kind of a ceiling on the level of how much money people are willing to put into this strategy, or how many people are out there willing to put money into this strategy. This isn't a reason not to do trend following, but it's a reason why you maybe shouldn't do trend following, which is that it's really, really difficult. And if you can, especially if you're going to trade manually, you need to be sure that you can cope with the kind of psychological knockbacks that come with it. Okay, that's the case for the prosecution, Niels.
Exactly, and of course we already now have the title for this episode, I'm sure, and that's something like "Why Not to Trend Follow," and people will think that we mistyped it in the.
That'll generate a few clicks.
Exactly, yeah, absolutely. No, I think your list is fair. Not all of it. I certainly don't agree with all of it. And before I reveal my little surprise, I will say probably the one I disagree with the most is this thing about the low sharp, because as we know, we're having a low sharp because a lot of the volatility comes to the upside. So low sharp in itself is obviously for a single line item less meaningful. But that's not why we are here today, right now. Because I thought when I heard your topic the other day, and I thought, what the hell is he talking about here? There was only one thing I could do, and that was to go to ChatGPT and type, give me 5 reasons, or give me any reasons why not to trend follow.
Oh, brilliant.
Yeah, brilliant. So of course you probably did the same, because ChatGPT and you tend to agree a lot. So let me reveal what our little AI friend thought about it. Of course, it's very diplomatic. It's very well trained. While systematic trend following can be a valuable investment strategy for many investors, there are maybe several reasons why some investors may choose not to allocate a portion of their portfolio to this strategy. Here are 5 potential reasons. Okay, so the first one it lists as risk tolerance. It says it can be highly volatile and may not be appropriate for investors with a low risk tolerance seeking stable returns. I think that's a fair point, actually. And, good on you, ChatGPT. The other one I didn't kind of agree with. It headlines it as diversification. And it talks about while systematic trend following can offer diversification benefits to a portfolio, it may not be the most effective way to achieve diversification depending on an investor's existing portfolio consumption. I guess, or composition. I guess that's true. Although I will say it does seem to have a pretty good diversifying effect on most portfolios. But fair enough, we'll let that slide. Then something you also mentioned, and I think it is important, should be mentioned, is fees. That some systematic trend following programs can be expensive with high management fees and trading costs, which may reduce their attractiveness to investors who focuses on minimizing expenses. Can't really argue with that, because of course you should always be concerned about fees, and you should never invest in a fund that has excessive fees anyways, regardless of what it is doing. Fourth reason is investor preference. It lists some investors may prefer other investment strategies, such as buy and hold or value investing, or may have ethical or personal reasons for avoiding certain types of investment. Okay, you can't really argue with that either, as such. And then the one thing where you certainly agreed, it was your first point. It's number 5 on the ChatGPT list, and that is just lack of conviction, that some investors may not fully be convinced of its effectiveness and benefits, and may prefer to allocate their assets to other types of investment strategies that they perceive to be more reliable or better aligned with their investment goals. So, I think you were kind of in agreement with our little AI friend.
Well, one thing that I say, listen to that list. Frankly, that's a very generic list of points you can make about any investment strategy. So I'm not sure whether that reflects badly on me or well on ChatGPT, but I feel like if this is a competition between me and ChatGPT, I really hope that you'll say it's clear from my answers that I know a hell of a lot more about trend following than ChatGPT does, which is just trotted out some generic nonsense.
I think we can say that is affirmative.
Because I'm now starting to get very concerned about my position on this podcast, Niels. I'll be honest with you.
Well, after you brought up this topic about why not to trend follow, maybe you should be a little bit concerned. But there we are, Rob. Anyways, you'll be back in a few weeks, and I'm sure there will be no talk about why not to trend follow. In fact, I'm sure there will be lots of good topics as usual, lots of education, lots of value, and that's why you are indeed very popular every time you come on. So with that, Rob, and thanks for the flexibility, because as you rightly say, I'm about to jump on a plane to Asia. So I appreciate you coming on early today. And I appreciate everyone listening to our conversation today. If you enjoy them, please go to toptradersunplugged.com/review. If you don't know already how to leave a rating and review on any of the podcast platforms, because they do really help. You can, of course, send questions to info@toptradersunplugged.com. You might even start thinking about questions for Rob in a few weeks. And next week, I am joined by Andrew, who was meant to come last week, but unfortunately couldn't make it. So this will be an interesting conversation. There's been quite a few articles out about replication of CTAs, managed futures. Rich and I talked last week about whether there was a decoupling between what Andrew is doing in his fund, replication of the SocGen CTA index, and the CTA index itself. We'll hear his opinions. We can talk about flows, how investors are reacting, and so on and so forth. So lots of great and interesting topics coming up next week, provided, of course, I can get the technology to work all the way out from Asia, which I'm sure will not be a problem. Anyways, thank you so much for listening from Rob and me. We look forward to being back with you next week. And in the meantime, as usual, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.